What if you could take the same amount of money, or let's say earn the same income that your next door neighbor earned, and you both could put that money away for retirement, and over the years you saved the same exact amount of money, and let's even say that when it's all said and done you had accumulated the same exact amount of money. But what if there were a way that you could receive up to 5 times the income that your neighbor is receiving from the same exact saved income? This is the importance of diversification of taxation. Okay, now what does that mean? Well, what we've been taught as a society, mainstream, is we've been taught about the accumulation phase of money. Simply put, we've been taught how to put money away. All we think about is how can we put money away and how can we make it grow. This is why we invest, right? This is why you're putting money into your 401k or your 403b or your 401a, right? Or your 457 plan. The only reason why you're putting money into those plans is so that the money can grow and so that you can have more later on in retirement. Now, one thing that we haven't thought about are the effects of taxation on those dollars. Now, many individuals, when I sit down with them and I ask them, well, tell me, why are you putting money into your retirement plan? Of course, the obvious reason is so that I'll have money for retirement. Another reason that I hear often is, well, it allows me to defer, some of the income so that I don't have to pay taxes on it now. See, what we've never been taught, and I quickly bring to the forefront, is that you're not actually deferring the taxes. What you're doing is you're actually postponing the taxes. You're postponing the taxation and you're postponing the calculation of the taxation on those dollars. What does that mean? Simply put, does anyone who's watching this video, do you know what tax rates are going to be when you decide to retire? None of us do, because tax rates can change on an annual basis. So we have to put a plan in place. And let me preface this by saying I'm not a CPA and I don't give tax advice. What I do is I teach strategy. Okay? Now, with that being said, we have to put a plan together that actually allows us to have income in retirement that is not taxed. Okay? Now, why is that important? It's important because, number one, if you earn over a certain amount of income, okay, your Social Security can be taxed up to 85% of your Social Security can be taxed. Okay? Now, if part of your income is taxable income, but the other part of your income is coming from a tax-favored, and that's a very important wording that I'm using there, a tax-favored environment where you don't have to pay taxes on that income because it's legally not income. You could actually earn up to $80,000 per year and still have your Social Security positioned where it's not taxed. Now, normally anything for a couple, a married couple, I believe it's approximately $42,000 can be earned on an annual basis before Social Security begins to get taxed. For an individual, it's a little over $30,000, I believe somewhere in the range of about $32,000, something of that nature. I don't have those exact figures available right now, but it's somewhere in those nature. So you're looking at in the $30,000+ range, between $30,000 and $35,000 for an individual. For a married couple, you're looking at somewhere between $40,000 and $45,000 in income on an annual basis. If you exceed those thresholds, your Social Security will begin to be taxed, and it could be taxed up to 85% of those monies could be taxed as ordinary income. Now, we all know that Social Security, you're not receiving a lot of money anyway from Social Security. So if 85% of it is taxed, it reduces those monies dramatically. Is that correct? I think all would agree. Now, what if you could stay below those thresholds as far as the taxable money, right, your Social Security income, but you could actually have additional money that you were pulling in that would keep you below the taxation threshold on your Social Security. There are strategies in place if you plan for the distribution side of saving for retirement, not just the accumulation side, and you learn about tax-favored vehicles. You could actually keep yourself below the threshold and keep, in many instances, 20% more money by planning for the distribution side of retirement. Okay, some of the vehicles that you can utilize, one flagship vehicle that I teach my clients to use is called an IUL, or Index Universal Life. How does this work? It's a life insurance contract, but it's properly structured in a way that it can be utilized for wealth accumulation. Right? Now, once again, let me put an asterisk next to that and let you know the primary purpose of life insurance is to provide a death benefit. But when properly structured, a life insurance contract can be utilized under current tax law to mitigate taxes and to receive an income in retirement that is not taxed, utilizing Internal Revenue Code 72E. Okay? Now, most of us have never been taught about Internal Revenue Code 72E or Internal Revenue Code 7702, which allows us to accumulate money inside of these properly structured policies in a way where the interest is tax deferred, just like it would be in your 401k. These vehicles, when properly structured, currently are the most powerful way to provide yourself with a tax-free stream of income during retirement. Now, not only can these vehicles provide you with a tax-free stream of income during retirement, utilizing Internal Revenue Code 72E, you can actually utilize a strategy called collateralization, okay, which will allow you to take from the same exact dollars that your next door neighbor has, anywhere from 2 to 4 times the income from the same dollars. This is something that I call amplification of our money. Okay. Now, wouldn't you want your money to work for you as hard as it possibly could? Utilizing a strategy of tax mitigation during retirement can change everything. The Index Universal Life contract, properly structured, can do this for you. If you'd like to learn more about how you can structure a policy and how these policies actually work as a critical component of your retirement portfolio, I'd love to talk to you about it. You see the buttons here on the site that you can actually schedule a 10-minute call, and I can actually explain to you how these policies work. And you can use your current advisor if you have one, and if you don't have one, unfortunately, only about 5% of advisors know how to really properly structure these contracts. So if you don't have someone, I'd love to help you as well. But that's a bit of information that you can utilize and you can research for yourself. Once again, it's called an IUL, or Index Universal Life Contract, and the IRS codes are 7702. Okay, that allows you to accumulate interest in these policies. Okay, and you're making above market rates on the interest in these policies, and you're basically mitigating in a safe and secure environment. You're protecting yourself from the downside risk of your principal, and I talk about that in another video. But it's a very safe place to put your money, where you can actually earn average above market rates, a reasonable rate of return, really a great rate of return on your money, while actually deferring taxes. And on the distribution side, you can have a stream of income of anywhere from 2 to 4 times what you would be able to do anywhere else off of the same exact accumulated money and pay no taxes on it under current tax law. So if that sounds like something that you'd be interested in doing, that could really anywhere from double to triple or even quadruple your quality of life during retirement, we'd love to talk to you. That's our bit of information for today. Be blessed.